So again, I'll call the Board of Investments meeting back into order after lunch. Hopefully everybody is ready to go. We're a little ahead of schedule, but doing well. So the next thing is tab 6, core fixed income. John and team are going to do a presentation to us. Be sure and feel free to pick on John if you want to. So go ahead, John.
Thank you, Jack. Jack said that he was going to be nicer, but we have yet to see evidence of it.
Intentions, John, intentions.
Right, good intentions.
You can be nice to the rest of your group.
Right. That's better. The board entrusts staff to manage a little north of $14 billion internally in core investment grade fixed income. That takes a team effort across the fixed income team, operations, accounting. We would like to give you an opportunity to talk to all of the staff, nearly all the staff involved in that process. It is very much a team effort. And with that, I'm going to turn it over to Kirsten Haswell, our fixed income officer, to discuss terminology and the background of fixed income.
Well, that was a great introduction, John.
Thank you.
All right, we'll start with what is fixed income? It's a contractual obligation. It might surprise you all to hear, but the fixed income team does spend a decent amount of time reading legal documents and contracts, bond indentures or private placement memorandums. And these investments can include bonds or CDs. They can be issued by governments or corporations. It's important to note that this is a claim on assets that's senior to equity. The coupons are contractually driven, but it can be fixed or floating or a combination of the two. And then maturities are predefined, anything from overnight to 30 plus years. And as much fun as it would be to read all of these terms to you, I will not do that to you. If you have a question on anything in specific, I'm happy to cover it. But instead, I'm going to ask Willie to pull up a specific bond that we can discuss here. This is a Disney bond. I like Disney because pretty much everyone knows what they do. They're a media company. They have 3 streams of revenue. Entertainment, which would be Disney Plus, their movies, licensing agreements, experiences. Like Dan likes to go to Disneyland, Disney World. That would be included in the experiences. And then finally, sports, which is essentially just ESPN. So what makes fixed income trading and management different from other asset classes, specifically equity? Well, if you want to buy Disney equity, you have one option. It's the ticker DIS, Disney. The market is very efficient. The price that's out there is the price you get when you're trading it. However, if you're looking at fixed income, Disney has 122 outstanding fixed income issues right now, and totaling over $42 billion. Willie will show some cool screens later to talk about relative value, but just giving that little tidbit now. So this bond in particular, you can see the maturity of this bond is 1/13/31. That means we have about 6.8 years to maturity. We do not confuse this with the duration of the bond, which is 5.7 years. While duration is measured in years, that's because of the math. It's actually how sensitive to changes in interest rates the bond is. So if there was a 1% change instantaneously in interest rates, this bond would gain or lose 5.74% of value, approximately. Let's see. The ratings on this bond, as you can see on the right-hand side there, low single A, that makes them investment grade, which means we can buy and sell a bond like this if it's on our approved list. Anything below triple B minus would be considered high yield. We would not work in that. That would be in Jason's realm, not ours. Finally, the coupon on this bond is 2.65%. That means for every $1 million you have invested in this, every 6 months you would receive $13,650 or $250. We don't confuse the coupon with yield to maturity either. The yield maturity on this bond is 4.40%, which is quite a bit higher than the 2.65%. That means the bond is trading at a discount. As you can see up in the top left there, about a $90 price. Speaking of prices, the way we trade bonds are based on a spread. A spread is considered the risk premium over and above the same maturity treasury. We usually measure that in basis points, as you can see up there. And now we don't have to read through all these pages of terminology unless you have specific questions. All
I have a
right.
question, how much coffee have you had today?
Oh man, I had a really big one this morning. Am I talking too fast for you?
No.
Okay.
Just a little concerned.
Yeah, no, fair. Let's see, objectives of fixed income. We look at total return. The income is, in general, the coupon payments were paid. Changes in market value can be either from changes in interest rates or changes in spread. Fixed income is a diversifier, has a different risk profile than the other asset classes, specifically in times of stress. We are more likely to preserve principal. And earlier I mentioned the claim on assets is higher than equity. So, you know, if the equity market is going crazy, the corporate bonds may lose value based on that spread, but it shouldn't be as large of change or as volatile in general, not always. Also, there's a flight to quality in times of stress. So treasuries that we hold tend to help if we need to raise cash in times of stress. Those treasuries would probably gain in value, able to sell them. The US Treasury market is also probably the most liquid in the entire world, so that helps as well. Go on to primary risk factors. In fixed income, we just want to get paid. And it'd be nice if we get paid over and above inflation. Inflation can erode our purchasing power of our cash flows. I use the example, we just had to buy new appliances, so the fridge we got delivered this weekend would have been, you know, $200 cheaper if I had gotten it about 3 years ago. So your dollar doesn't go as far if inflation is high. Maturity risk, 30 years ago, IBM and Apple would have been good investments, but so would Kodak, GM, which went bankrupt and got a government bailout, and Compaq, the computers, which also went defunct and, you know, 10 years later were bought by HP. You know, the longer to maturity you have, the more risk there is seen. Default risk, I talked about going bankrupt, you know, investors require a higher risk premium for what people consider riskier companies. Finally, liquidity risk. We negotiate all of the prices on our bonds. So again, equities, right? The price is the price. The market is very efficient. We can try to negotiate a better deal on our bonds, but of course that takes time. Moving on to everyone's favorite chart here, the teeter-totter. Yes, if you don't remember anything I said today, remember this here. Bond prices and interest rates have an inverse relationship, meaning when interest rates go up, our bond prices went down. That is the scenario we've been living the last couple of years. But the good news is, because those interest rates are up, our cash flows in, we're able to invest at that higher interest rate. If there are any questions, I'm happy to answer them, or I will hand it back to John.
Thanks, Kirsten.
So if I can refer the board to slide 10, maybe we'll talk a little bit about the who, what, and how of how we invest the core fixed income. On slide 10, you can see the 14.2 billion that we invest. Large majority of that is in STIP, about 8.8, almost 8.9 billion in STIP, about a little north of 2 billion in both cap core and trust fund investment pool, and about half of that amount in state fund with a few other small pieces that we invest outside of the pools. To the right there, you can see the level of effort that takes, about 63 billion in transactions for the year, a little north of 2,300 transactions to get that done. So again, it takes a team, not just the fixed income team. It takes a lot of effort from accounting, and we appreciate their efforts greatly. I always say that the only thing accounting does is help me, and the only thing I do is make their day worse. So we do appreciate those efforts. In addition to accounting, it takes a heavy lift from our operations and compliance team, and Tim House from that team will talk to you a little bit later. Going on to the next slide, slide 11, this gives you a flavor for the clients for whom we invest the money, both in terms of who they are and what type of client they are. You'll note the blue highlighted entities. Those are new accounts that we had since we showed you this last. So it's interesting that we've got new clients in almost all of the what we think of as fund types. Those fund types are permanent trusts, expendable trusts, insurance funds, and operating funds. So what type of fund is important when we work with the client to establish and develop objectives and constraints? So we'll talk to the new client about their constraints, their objectives. Their objectives are generally, I want to make money to use it to fund my operations. And that's kind of simplistic, but it's a little bit of a chicken and egg process that you have with the client. They want to know how much money are we going to make them, and we need to say, okay, but how much money do you need? And you go back and forth, and at the end of the day, you come up with a rational allocation, and you're able to choose a benchmark and define investment guidelines for that client. And then that's when we bring that investment policy to you, to the board, for your perusal and hopefully approval. Once we get that approval, then we construct the portfolio with a mix of assets. Maybe it's STIP, maybe it's trust fund, maybe it's a combination of both. Occasionally we might have other things in there. We'll do that based on what we think their cash flows are, where we think interest rates are going, relative values among sectors. But that's not the end of it. Then, once we establish that, then we monitor that portfolio, essentially every day, but more formally amongst the team, and usually with John Putnam in a weekly meeting where we go over portfolios and what our expectations are, and if there's been any change in expectations. So we continually evaluate the underlying securities. meet regularly and try to have discussions with the clients to see if any of their needs have changed over time. All of the team members participate in that process. All of us have clients for which we are primarily responsible, and then also all of us are backups on for clients. So as part of that process, we're continually searching for improvements in efficiency, thinking, electronic trading, systematic credit research process, using Bloomberg data. So the types of investments that we use for the clients can be, the default is the short-term investment pool. So if we don't have the ability or do not think it's prudent to invest funds in the trust fund investment pool or other securities, or as can happen, the client can just be unsure of their expected cash flows and their expected expenditures. And in that case, then the default is that all the funds are invested in STIP. So it's similar to a money market fund in several ways. The most compelling for the client is that we transact that at a buck. We do not pass through the very minor changes in market values of the underlying securities to the client. Instead, we just do it at $1. So that provides significant liquidity to the client. The client does not rely on us to make transactions into and out of STIP for the most part. Instead, they're making those transactions themselves through an electronic process wherein they go into what we call the TA, or the trade agency, and they make a transaction. If they do it before 2 o'clock today, then they get their money out tomorrow. So they get that, they get a modest increase in yield, and so it's a compelling investment for the participants. The trust fund investment pool is a longer duration, a much longer duration portfolio that diversifies investments and over the long term increases yields. We've got a funny situation right now where we've got an inverted yield curve. So STIP can in fact out yield the trust fund currently, but in the long run, we expect trust fund investment pool to out yield STIP. And then individual securities we occasionally buy for our clients in special circumstances. And the majority of that special circumstance is going to be when they have an expected expenditure sometime in the future that they would like a security to mature to match that expenditure. So that's usually what we're doing when we're buying separate securities. To talk a little bit more about the trust fund and STIP, I'm going to turn it over to Sam Holman, who is a fixed income investment analyst on our team.
Thanks, John. Good afternoon. As John mentioned, I'll be talking a little bit more about trust fund and STIP. And just to kind of summarize what John just talked about, majority of our non-pension clients' funds go into trust fund and STIP, and those allocations are determined in policy and then also through continuous conversations with our clients. So first I'll kind of get into trust fund. The purpose of the trust fund is to provide our clients with a longer duration pool, which offers additional diversification than what STIP can offer. The pool assumes a prudent amount of risk and typically provides a higher return due to this additional risk. And we preserve principal by diversifying the portfolio across risk factors. One nuance I would mention about trust fund is we're only able to move clients' money in and out of the fund on a monthly basis at the beginning of each month. So we try and manage the clients' accounts in a way that provides enough liquidity to meet their cash flow needs while also maintaining a sensible allocation to the fund. All right, moving on to slide 16. here we can see kind of how we have the securities in trust fund allocated. Majority of it is core fixed income. We also have allocations to real estate, real assets, and non-core fixed income. Within the core fixed income portion, we hold treasury notes, agency or US agency bonds, asset-backed securities, corporate bonds, and other securities. And the total market value of the fund is just over $3 billion. One thing I would note here is we like where this is positioned currently, but we do think there might be additional value in real estate. So we could look to add there, but the pace and timing of that is uncertain at this time.
Okay, but Sam, who makes a decision on that kind of thing? Because you're dealing with the core fix, right?
Yes.
So you're working with your CIO and other investment managers about whether or not you can make a play in real estate?
Yeah, so we have a meeting every week with John and John to kind of discuss where we want to be positioned.
Okay.
All right, moving on to slide 17. So trust fund distributions, they're an important factor to our separate account clients, as it's the money that's actually coming back to them that they can use in their operating budgets. So as a team, we attempt to maximize these distributions over the long term. In the chart here at the bottom of the screen, this is the yield to worst of the index, and the trust fund distribution or the trust fund yield tends to follow similar patterns but at a lagged pace. For example, in 2022, we saw distributions drop, and that was a lagged response to the drop we saw in yields in 2020. And then in 2024, we saw distributions increase, which was lagged to the increase we saw in yields in 2022. And then our allocation to real estate and real assets kind of smooths out how the trust fund distributions look compared to this. Our allocation to real estate is expected to continue to kind of smooth out the fluctuations in distributions in the long term. And then any questions on trust fund? All right, we'll go ahead and go on to STIP. So STIP is our short-term investment pool, and as the name would imply, it's much shorter and as such typically yields much less. As John mentioned, that's not been the case for the last, I don't know, since I've been on the team, over a year and a half. STIP has been yielding more than trust fund. That's due to the inverted yield curve. It's interesting to look at where the yield was and where distributions were at when I started as an intern over 4 years ago. The distributions were less than $1 million a month, and now they're over $30 million a month. And the yield was less than 1%, and now it's over 5% and has been for a while. The STIP income has become a significant revenue source for the state. In fiscal year 24, STIP distributed $447 million to STIP participants. Some of our objectives, our main objectives in STIP are: 1, preservation of principal. We do this by investing in safe and short securities, primarily treasuries, asset-backed commercial paper, CDs, US agency bonds, and money market funds. Liquidity is also important. STIP is the source of cash for most of the state's payments and obligations. We have to make sure we have enough cash inflows every day to cover outflows, which are both expected and unexpected outflows. Some of these outflows, more common ones, include pension payments, payroll, pro card payments, and things like that. And then the last objective I'll talk about is return. We attempt to minimize costs and maximize distributions, and this has led us to, historically, we've performed in line with other similar money market funds and pools. And then this is my last slide, and I'll just kind of read through this, not a whole lot of color to add here. So all the securities in STIP are highly rated. STIP is diversified over asset classes. The weighted average life is 146 days, and the duration is 0.14 years. 1 day liquidity is 16.8% of the pool, or over $1.4 billion. This is not just cash sitting in the account, in the fund, but investments in treasuries and other liquid investments. Nearly 30% of the portfolio is invested in US government and agency bonds. And at the time this slide was created, yields were steady at about 5.35% and expected to decline. We've already seen some of that decline happen. The average yield for the month of August has been about 5.28%, and it's going to continue to decline given the upcoming rate cutting cycle. Any questions on STIP?
Sam, I'll ask a question here. So your yield curve has been around 5.35, but it is decreasing. So what does that do to your duration?
Person, do you want to talk to that?
Yeah, I would say for STIP particularly, so this says weighted average life. We usually look at the weighted average maturity because that takes into account floaters, reset dates and callables, being called essentially. And so I would say earlier this year, we knew, earlier this summer, I should say, we knew rate cuts were coming. The market was already starting to price them in more aggressively than we thought they would happen. But to counteract what we think and what the market thinks, we started to extend our weighted average maturity. We got to 60 days right near the end of July, and now we're probably sitting in the low 60s as well, which is probably about neutral for us or so. But looking back, I don't know what the board book says, it was probably in the 50s, but we were as low as 48, 47. So on a percentage basis, that's quite a bit longer, but constraints of STIP with liquidity, we can't get much longer than that. We extended that duration almost exclusively through longer T-bills and 1 year-ish CDs.
Mark, I would just add, as a technical matter, a decline in interest rates actually increases the duration of the portfolio, but particularly for STIP, that's a very minor amount.
All right, I'll go ahead and hand things back to John to talk about state fund.
I guess I could have stayed up there. Let's see here, if I could refer the board to slide 20, where I'll talk a little bit about the state fund investment portfolio, which is a little bit of a unique breed of cat for us in that, as a separately managed account, it has most of the asset classes that we manage here at the Board of Investments. Obviously the core fixed income, but also allocations to both domestic and international equities, real estate, real assets, and core plus allocation. So we do all of that to obtain their strategic objective, which is to make sure that they have the assets and earnings to meet their liabilities and maintain a stable, cost-effective rate for compensation. So how you do that, for the most part, is generate a good amount of cash for them to use to offset the costs of their operation there, while preserving the principle of the underlying assets. A secondary objective is capital appreciation. And that's kind of what we use the equities for, is we hope that grows their ability over the long run to continue to have good, stable, and significant cash flows. Any questions on state fund? If not, just looking at the next slide, just want to point out one of the competencies that we feel the internal management of fixed income has, is that its costs are very low. For instance, the cost for the internal management of the core pension fund is just 1.6 basis points, or to say it differently, just about 0.02% of the underlying assets annually. Some other core competencies that we think we have and are, well, the experience. We've been doing internal management of fixed income since I believe about 91, before even my time. I've been doing it for a little north of 23 years now. John, nearly 20 years. So that experience gives us the ability to define an investment process that's robust and well thought out. And so the advantage of that is that we can bring in new people, as we did with Sam and Willie just recently, and they can fit into the investment process and start adding value in a fairly short time. Additionally, we have the ability to control those investments. For instance, you might have heard me say that John and I have a handshake agreement for the pension core fund that we're gonna have about 75% of the index weight in corporates. And the reason is because part of the use of that portfolio in pension is to offset some risk somewhere else. So why would we take equal or even higher risk if that's its goal? And so that's one of the things we can do because we control the underlying assets. And we've had solid long-term performance across all the portfolios and benchmarks. So feel like it's a core competency of the team. I'm gonna turn it over to Willie to talk a little bit about some of the resources and how we use them. Willie is a fixed income investment analyst.
Mr. Chair, members of the board, I'll be talking through some of the tools that the fixed income team uses on a regular basis. To do that, we'll go through 3 examples of real tools that we use. The first will be the credit matrix, second will be Bloomberg, and third will be market access. And we'll do that within the framework of a real actual trade that we did just a few weeks ago. So I believe you all have a printout at your desk that looks something like this. Thank you, Savannah, for printing those out. What you're looking at is a blank, and I can read first. Got it. Okay. So what you're looking at right there is a blank generic template of the credit matrix that we use on a weekly basis. We have an approved list of about 100 investment grade corporate names across all sectors. Each member of the team is assigned a certain number of sectors and completes research on their sectors throughout the year. Any member of the team can take off a name from that list at any time for any reason, but in order to add a name, you need to have team approval. The reason for that difference is to help combat behavioral bias. For example, if I started about 1.5 years ago, maybe the first company that I started researching, I had a strong emotional connection to, but it's just not that great of a company. And maybe, for example, Sam sees that and says, I don't think this company should even be on our list. And just like that, we can take it off. And so that's a way that we can make sure our list is precise and it's doing what we want it to do, and we don't have any sort of bias within our potential investments. Going back to the actual credit matrix that you have in front of you, you can see that we rate companies in 6 categories. The first is industry risks, which is Porter's 5 forces. Next is company risks, which helps quantify where the company sits within its industry or industries. Management and ownership is the next category. That's our evaluation of company management and their competency, potential structure, and any other issues that might come up. Balance sheet support and support from operations are both heavily quantitative categories. Those pull from financial statements. And then earnings growth is a way to quantify our projections of whether or not a company will be able to meet future financial obligations. Each of those 6 categories is made up of several metrics within the categories. And so each of those metrics is scored, and then those scores are aggregated into the scores that you see on the right-hand side of your table in front of you. You can see that we track those over time, so we pay attention to what's changing within a company and within an industry. Those individual category scores are summed up into the total score that you see in the green row on the bottom of your sheet. That score helps us basically assign a relative value to a company, and we can kind of begin to get a picture of where we view this company in relation to the rest of the approved list, the rest of the industry, and in relation to how the rest of the market views that company. And so going back to Kirsten's Disney bond that she was talking about, we did this process for Disney. We do it for every company on our approved list. And to reference again, the trade that I previously briefly talked about, we also did this research on Disney. And so at one point we had Visa and Disney research done, and we were able to determine there might be some value if we would sell a Visa bond and buy a Disney bond. And we'll get into exactly what the next steps are in that process in the Bloomberg screens. So before I move on, any questions on the credit matrix? All right. So again, a few weeks ago, Kirsten was looking through the FIW screen, and this is one of our favorite screens within Bloomberg. On the x-axis down here, you have time to maturity. On the y-axis over here, you have G-spread. G-spread is a measure of the corporate bond yield over the nearest maturity treasury. And so the farther down on this graph a bond is, the more expensive it is, which is thanks to the inverse relation between yields and price. And the higher that the bond is on this graph, the cheaper it is. And so when Kirsten was looking at Visa and Disney, she happened to see this Visa 2031 bond, which at the time was way down here at 30 basis points. On the other hand, this Disney 2031 bond was up here at 75 basis points. So she's looking at this and she's seeing, all right, so Sam did the research on Visa, we have research on Disney, looking at our credit matrices. These are both strong companies from our point of view, but we believe if we sell this Visa bond, we can add value to the portfolio by replacing it with this 2031 Disney bond. And that's what we ended up doing, and that's how we can use, this is just one aspect of Bloomberg and an example of how we use that to add value to the portfolio. If there's no questions there, I'll move on to the final tool, which is market access. And market access is one of the softwares that we use to actually execute a trade. Wait for that to pull up. So at this point, we've done the research on these companies. We've looked in Bloomberg and gotten some real hard analysis on what value that trade might add. And now it's time to actually execute the trade. There's 2 methods through which we can execute a trade. The first is through brokers, and that's kind of the more classic way. You reach out to one of the brokers that we have a relationship with and basically say we want to buy bond X and sell bond Y at price A and price B. Can you get that done? They'll say yes or no, or maybe negotiate on price. But that's method 1. Method 2 is going out to market access, which is what we're looking at here. And so this is a software that exposes us to the entire market. What we're looking at here is all of the Visa bonds that were put out by different participants today. So these blue ones are old, but this black one here that says live under status is an example of someone, some market participant similar to us that's looking to trade this particular Visa bond. So if we were interested in executing this trade right now and we sent this out, our trade would pop up right here, and anyone who would be interested in being the other counterparty in that trade would be able to give us a price. And so it's just a really nice resource to make sure that we're getting the best prices available in the market. And one final use for market access is that if we are working with a broker, we can use market access for price discovery by throwing a small amount of a desired swap out there, getting market pricing, and knowing that when we talk to the brokers, we have a reasonable and fair price in mind. So that's the three tools that, or some of the three tools that we use on a fairly regular basis. And again, looked at those through the framework of a recent Visa and Disney swap. And that just kind of goes to show the teamwork element that we have in the team. Visa is Sam's name, Disney is Kirsten's name. Kirsten was able to find that swap, and the whole time that was going on, Tim and the rest of the operations team were working on compliance in the background. And with that, if there's no questions, I'll hand it over to Tim to talk a little bit more about what operations does.
I'm Tim. If you'd please turn to slide 26. I'm in operations and compliance along with Matt Hoffman and Aaron Kirpin. Our job is to turn the policies that you guys approve into actionable items that we can put up in Bloomberg to put up guardrails for the different accounts to make sure that nothing is out of policy, that it's caught before anything happens, and to keep monitoring it. As markets change, then they can come out of compliance as well. What you're seeing here is, it's called Compliance Manager. It's a Bloomberg product. CMGR is what we call it. These are examples of the rules that we have set up for the accounts that reflect the policies. I know it's small writing, but if you can just imagine, we only allow 3% in a single issuer. So one of these trades would be only allow 3. Oh, you're gonna pull it up, that's good. So that fourth one down, 3% max COR is 3% max issue in any corporate name. So in Disney, for example, you can't go over 3%, or lights will go off. So it's just a way to set up guardrails that mirror our policy, that keep us within compliance and keep us within policy. It's real time as they're doing the trade. Sam will show you later on in a real trade that an actual button is pushed pre-trade, and during the trade, if the trade is actually made, another or attempted, another light comes on that flashes in my office on my monitor. So it's like I said, a way to keep us in line, keep within the guardrails, and make sure that all of the accounts that we trade in-house here are in policy. So we make the rules up. I go into Bloomberg and actually make these rules. We have to have a second set of eyes for any change. I can't just go in and make a change myself. We've got to have a second person that goes in and actually activates it if it's something. So like John was talking about change in policy today, about how we would look at the ratings agencies. That we've got to look and see if that's something that we can quantify and stick in Bloomberg. So with that, if there are any questions?
How often do you catch these guys doing something wrong?
You know, they catch themselves before I catch them. So they're looking at it themselves before it's more likely that they have some, and you can open up one of these and actually see what kind of room you have. So if it's a 3% max and you're sitting at 2.8% and you want to buy 3% more, you just go in there and look and it's like, oh, okay, I can only buy this much, or I can't buy this at all. Any questions with compliance?
And they all talk to you and everything?
Oh, you know, I used to be right next to them. So there might be a ding that might go off in my office and somebody somebody would holler across and say, whoops, oh, hang on, Tim. But yeah, we work really closely together. They allow me into a lot of to see a lot of what they do, and it makes it a lot easier for me to do my job. Any questions? All right, I'll turn it over to Sam.
All right, the fun part. Fun is relative, but we think it's fun. Let's see. Let me share my screen really quick. So I'm going to be executing a trade. We're going to be buying a treasury bill in STIP. So Kirsten and I talked earlier, and we decided we wanted to buy the 6-month T-bill to replace a maturity that's rolling off tomorrow. So I already have this queued up. So we're gonna buy $50 million in STIP.
Are you actually doing this right now?
This is live.
I'm a little nervous.
You wanna come up and push the buy button?
Best video game ever.
So this will be, so I entered the 50 million up here. This will be in STIP. The fund code for STIP is MU36. And as Tim was just talking about, they have all those rules in the background. So I'm able to hit this 6 go for compliance button, and that will run pre-trade compliance and run this trade throughout that list of rules that he just showed to make sure I'm not doing anything I shouldn't be. So I'll go ahead and hit this. And that little flash on the screen means there was nothing that was flagged. So we're good. Maybe just as a demonstration,
Can you override that at all?
We cannot. Sometimes, Mark, we'll go down and talk to Tim, and for instance, we'll get a violation that this trade will make your cash go below 1% in state fund. And then we'll go down and we'll talk to Tim and say, well, here's what I see for our cash with all the outstanding trades that are happening. And if we can approve that to Tim, then he will agree and he can pass that trade through.
So maybe to demonstrate one of those rules, so we're only able to trade $75 million at a time. So say I accidentally type in 500 million. When I hit this compliance button, we'll get a warning saying, let's see, no trade to exceed $75 million, and I can't get past this. I can't push this trade off to the desk. So I'll go ahead and change this back. So in addition to me hitting the compliance button, it also does it automatically when I send it off. So I mean, doesn't hurt to hit it several times, just because. So I'll go ahead and hit send, and this will send it to the desk, where we will eventually send it off to brokers for some prices. All right, so this is our TSOC screen. So from here, I'll click on the trade, and down in this bottom part of the screen, this is where this bill is currently trading. So I'll typically just look at this to kind of see where it's at and have kind of a level in mind before I send it off to the brokers. So 484. Then I'll hit this send button.
So,
Get this
so
screen.
Sam, was
Yes.
that just to give you an idea of what was out there, what's available?
Yeah, well, not what's available, but where it's trading.
Where it's trading at?
Yeah. So in this screen, I'll just go through and again, double check all the details. $50 million, it's the 227 bill, settles tomorrow. All that looks good. I'll check this broker box, and this will automatically select the top 5 brokers with the lowest prices in the market. we're only allowed to trade or submit it to 5 at a time. Occasionally, we'll go through, and if we know, say Bank of New York doesn't trade very frequently in the afternoon, I may uncheck that box and select a different one, but doesn't happen very often. So from here, I would hit submit. Before I do, I would just highlight on the next screen, the Bloomberg will put the offers in order of, I guess it'll put the best at the top. So usually I can just select the best. If there's 2 that have the same price, I will have to pick between the 2, but that doesn't happen very often. But Kirsten, does it look good?
Yes.
$50 million is a lot of money. So I'll go ahead and hit submit. Check compliance again.
So once again, how, you got 5 brokers there that you're put this out to.
Uh-huh.
How did you get those 5?
It automatically selects the top 5 when
Top 5?
yeah.
Okay.
And if you unclick one, does it pick the next one then down?
I would have to select the next one.
Oh, you
Yeah,
have to.
yeah.
Okay.
All right, so this is the best one. Go ahead and hit. And it's done. We just spent $50 million. As a courtesy, I would typically message Tim and let him know that this trade is done. And Ops is always monitoring to see what we're doing, but it's nice for us to give them a heads up so that they can then send the trade info off to our accounting team so they can book it, and then also our custodian. Any questions on that process?
So you say there was one that's maturing tomorrow and then you're buying?
So this
Will you
settles
notify them of
tomorrow.
both, or would they already know?
Say that again?
Would you have to tell them about the one that's maturing and the one that you're buying?
No.
They should know about the one, right?
Yeah, the one, yeah.
Okay, but for example, in that example, so let's say that if you were gonna buy this $50 million and and it was going to put you over that 3% threshold, you'd have to go to Tim and say, but I got this other one that's maturing tomorrow, so you could do the transaction.
Yes, we don't do that. We typically, if we have something mature during the next day, we'll wait to execute this trade until tomorrow, just so the maturity date and trade dates line up. All right, I'll hand it back to John to wrap things up.
Yeah, so hopefully we demonstrated that it does take a team to do this. It's a big lift, $14.2 billion. We recognize the gravity of the trust that you've put into us. Between what we distribute in STIP and the trust fund investment pool and state fund, not including the value we add to the pensions, we distribute over $600 million to the governments of Montana to help them achieve their purposes. And I can't help but feel good about that and feel like that matters. And I just want to thank the board for giving me an opportunity to do what I think is the most interesting and fun job at the state. Thanks.
Thank you, that was
Thank you.
excellent. See, I was nice to you.
Yes.
Mark it.
Well, it won't last. I've got performance.
Okay,
Should we take a quick break now?
you want a quick break?
Yeah, and then come back and.
All right, let's take a real quick
Real
one.
quick.
And Maggie's in charge of. Back, we'll continue the board meeting and stick on our schedule. Next thing is RVK, so Becky, it's all yours.
All right, well, thank you. If you'll turn to the section 1, page 6, we'll start the report there. I will move you back and forth a little bit in terms of order of pages, just to help with the flow of the commentary. But on page 6 of that first section, it should have the total fund performance of the public employees plan. And right in the middle of that page is a chart that shows our fiscal year-to-date return of 9.07, our benchmark return of 9.7, and our rank right there in the 57th percentile. Just to the right is the longer time periods where you can see the return for 10 years of 7.4, beating the benchmark, ranking in the 10th percentile. So we're just a little bit under our benchmark in this particular fiscal year for all the same reasons that we have talked about in prior years due to our private assets having a benchmark that's very different than the actual holdings that we have. And the fact when we compare ourselves to other funds, I'll show you in a few pages, that we have more real estate than some of the other peers, which was one of the things that influenced our relative rank. But no concerns, no issues. We love that 9% rate of return relative to our assumed rate of return for the pension plans. So a very good fiscal year. Some of the commentary in section 1 is really geared more towards just the second quarter, and I'll really make more comments as it relates to the total fiscal year results. So if you go backwards just one page, I've got a couple things I wanted to go through. First is that figure 3 at the bottom of page 5 that actually shows you some of these measures that we talk a lot about in terms of economic and related activity. If you look at the federal funds rate, the 5.3%, of course, has been on hold for some time as the Fed hasn't moved. That's where we've been parked for some time, and we expect to be coming off those levels with the first Fed cut, which looks like will probably be in September. If you look at the history of that across the row, look at the 10-year average federal funds rate, 1.5%. Doesn't this kind of feel like the frog in boiling water situation where we had the Fed turning up the heat in terms of increasing interest rates? And it did happen fairly quickly, but if you just look at the dramatic difference between the environment we've been investing in for a very long period of time versus the more recent period of time, when it comes to federal funds, is quite a stark contrast in terms of having those higher interest rates. We're talking about what's going on with the shape of the yield curve. If you look at the Treasury 2-year and 10-year, here we have that situation where the inverted yield curve was present right there, where you had 2-year securities earning more than 10-year and more than 30-year. But that again has started to change with the 2 and 10-year being equal today. If you look at the long-term history, again, that dramatic difference. If you look at the 10-year average 30-year Treasury, it was yielding 2.9%. That's not a lot of payment to investors to lock up their money for that long a period. So again, expect all these things to be changing. If you look at a couple of other notes here, inflation, per the Fed's mandate, self-imposed mandate, they really want that inflation measure to be at 2% or lower. If you look where the CPI is year over year, it's 3.0%. And if we look at the other measure that isn't on this page, which is core, it's a little bit under that. Or actually, we're now at about 2.6 on the CPI, and that has been great. So it's actually been a little bit better since this particular report. Another thing that is a little bit more subtle is the US dollar total weighted index compared to last year, or compared to Q1, compared to Q4 2023, and compared to 10 years. The dollar has gotten stronger through this period of time. And there's been a lot of articles talking about that could weaken now that we are on a path of lowering interest rates in the near future. But what happens when the US dollar is stronger is that actually weakens our non-US investments when we translate them into US dollars. So that has been a bit of a headwind when it comes to our international equity investments, for example. Towards the top of the page is interesting. This is actually looking at the CPI that's in that sort of olivey brown line. It also shows the federal funds rate, which is the very flat yellow line. And in blue is the Purchasing Managers Index for services. In green is the Purchasing Managers Index for manufacturing. And what this is really showing you is this is a quarter by quarter, play by play, if you will, is you can see that economic activity starting to come down and tail off. So one of the things, as you know, the Fed's been trying to do is manufacture a softer landing, not a hard landing by keeping rates too high for too long. So as we've seen some of these measures, including the labor market starting to soften, it does seem like a very logical move that the Fed would pre-announce the fact that they will be reducing interest rates. If you move now to page 7 of this same section, what are some of the tools in our portfolios that were part of that 9% rate of return? This actually spills over into the next page as well. It really is amazing when you look at the middle of the page on the fiscal year to date number. A strong contributor to that 9% rate of return was domestic equity being up 22%. Very unusual year, very strong, obviously dominated by the tech sector, the Magnificent Seven, or the stock of one, as we were talking about in the video's results. So it certainly did help, and we had a full participation in that market run because of our indexing strategy that you used in domestic equity. International equity had a return that was roughly about half that, a return of almost 10.9%. Here we've got a mixture of active and passive managers. Our rank has been at median, a little bit below median during some of these periods of time, primarily due to the value versus growth cycle overseas, the amount of indexing that we have in our portfolio versus active managers. And certain types of active managers were a little bit more successful during this period. But as you can see in the most recent quarter, in the 35th percentile, and calendar year to date, right at median and beating the benchmark. So again, a nice contribution from international equity. On page 8, we continue with the other asset classes. Core fixed income, a return of 2.8%, beating the benchmark. Keep in mind that a lot of plans do combine the core fixed income and non-core together, and they would have gotten a bigger rate of return during many of these periods by doing that. So when we look at our rank for the core fixed income allocation in the 70th percentile, we're not concerned. We're beating our benchmark, and we know that we have an extremely core fund that isn't going into some of the other plus sectors that even some other core managers do have a small percentage in emerging markets or a small percentage in below investment grade or high yield fixed income. Our non-core portfolio is a mixture, as you know, of high yield as well as preferreds and emerging market debt. During this particular period, we actually had a return of 9%, which was a great return for non-core fixed income. It is below our benchmark, as you can see, and the benchmark is really just high yield because we had a number of strategies inside of that. Helping that to contribute to the 9% rate of return was 9 to 10% from our high yield managers, but we actually had a 14% rate of return from our preferred securities manager, preferred stock manager, and our emerging market manager had a return of 6 and convertibles around 2. So there was quite a basket of strategies in here in that non-core fixed income. The total result was great. It just happened to be a little bit below high yield, and our high yield managers have tended to have returns that have been a little bit more conservative and positioning slightly more conservative than the benchmark, because what has been doing well is even lower graded securities within that below investment grade. So the junkier junk, if you will, inside of junk bonds has done even better. Real assets had a return of almost 7%. Real estate is the only asset class in negative territory here. As you know, the pricing of those properties has continued to roll through softer pricing, although yields have been productive. So there is hope and some speculation. If you look at the rate of return in nearer periods, the quarter and calendar year to date, that we seem to be slowing down in the marks going down in price for those real estate properties. So we're hopeful that we're closer to the end of that cycle that we've seen in place for this fiscal year, certainly, and a little bit beyond. As we look at private investments, you also know that the public markets have outperformed private investments. Part of the issue is that those private investments don't mark to market as frequently. There's much less volatility because they are marked infrequently and typically to a model or to discounted cash flow analysis. So in this period, a return of 4% in private investments, it's a combination of private credit and private equity. This is a positive return. Our benchmark is really representing the public expressions of those same asset classes, and you will see underperformance. This is a very consistent theme to what we've seen in prior years when the public equity markets have been running, and in this case also bank loans, which is part of that benchmark. Cash, when's the last time you expect to see a whole year's return of cash being 6.3%? Again, that will start backing down as we see yields going down. Our trust fund investment pool and short-term pool are at the bottom of the page. Positive rates of return, again, much more muted in the trust funds investment pool because of the emphasis on fixed income as well as having the inclusion of real estate. So, bottom line, these were the tools, those that you saw from cash upward to private equity, non-US or non-corporate income and equity. It was a great fiscal year at 9%, and these are some of the tools that you had in place to earn that 9%. I was going to have you skip ahead to page 11 real quickly. This is in the next section that is the capital markets review. Just to keep our eyes a little bit on the macro here as we look at the economy and even fixed income. When you look at the economy in the upper right-hand corner, this gives you a little longer-term perspective of where unemployment has been in history since 1948. We still have very low unemployment levels, although it has crept up, as you know, in the last several weeks, and we had that strange revision on jobs that just disappeared in the data. So it'll be very interesting to see what happens on the unemployment picture. The CPI, or where inflation is today, again, we saw 9% within the last couple of years, which is so nice to not be there any longer. US government debt, as we talk about almost every time we get together, is very high. It is something that is actually high internationally as well. And so since the pandemic, we've seen those elevated levels in a lot of different types of economies beyond, or a lot of different countries other than the US, but it is a long-term issue for sure. And the cost of that debt, especially debt issued more recently, is very expensive because of where interest rates have been. Volatility has fallen way back. As you know, in early August, there was that panic that we saw in the marketplace and markets correcting. We've actually seen that go way back down. This was a June assessment, but as we look at more recent days, that's also been much calmer. And consumer confidence is around median, which if you think about what the consumer's been through in the last couple of years, it's kind of surprising. The consumer has tended to become comfortable because it appears that the economy is doing well. Relative to what it could be for having inflation just a couple of years ago that was at 9%. The shape of the yield curve is actually shown in the bottom right-hand corner of this page. That has changed a lot. I just wanted to illustrate how much higher interest rates are if you look at the three lines that are grouped at the top, which is June, March, June of this year, March of this year, and June of a year ago, compared to June of 22 and June of 2021. So again, interest rates are significantly different. We're off of the zero mark, and again, probably a more normal types of interest rate levels as we go forward with a few cuts in the future. Now, the election. We had to put a page somewhere in here about the election. On page 12, we did that. We actually looked at the history of the S&P 500 going back to 1926, and we looked at the returns for the full calendar year for the S&P 500 in election years, for the full calendar year, in election year, and then non-election years, and then all years, saying, did we learn anything? And really at the end of the day, if you look at the equity returns, as you would expect in an election year, there tends to be a little bit more volatility. If you look at the blue line for the third quarter, you can see across all those periods, as you're looking at the quarter ended in September, that's when a lot of uncertainty is really building as voters are thinking about what their strategy is going to be and all the messaging that goes to the market. But if you look at all the quarters together and look at the information in the red box for equities, you can see that the presidential election year returns of around 11.6 look a lot like the returns in non-election years of a little over 12, and all years together has been around 12.2. So not a lot to learn here other than we would expect volatility as there is uncertainty in the market, kind of regardless of what the source of uncertainty is. Investors don't tend to like it, but in the case of election years, it really hasn't led to a lot of different results. And the same is true of fixed income, and that's in the bottom box, since 1976. So enough about elections, in this report anyway. If you look at the next page, page 13, I'll go quickly here. There's just a few more market environment things that I thought would be interesting to note. If you look at US equities, something we've talked about for, it seems like many quarters, many meetings, is how expensive US equities are. If you look in the bottom left-hand section, we did see a little relief in the price of US equities, relief because we had losses in 2022. But if you look at the relative prices compared to the earnings of companies in the US equity market, in all but the small cap realm, we see that prices are pretty expensive. And so that is something that we do take into account as we look into the future about prospective US equity returns. If you look on the upper right-hand section of this page, the best performing strategy in the 1 year ending in June that aligns with our fiscal year is large cap growth. Big surprise. That's where technology is. That's where NVIDIA is. A return of 34% nearly in those stocks. Again, demonstrating some of the narrowness of the market. If you look in the bottom right-hand corner, this actually divides by sector. This is actually taking the large cap market and dividing it by sector, and the light blue is the return by sector. And you can see information technology and consumer services, the best returns by far compared to all the sectors, but we did have positive returns across the board for all sectors in the S&P 500. The next page, I'll just go over the bottom left-hand section on page 14, and that is the relative valuation of non-US stocks. They're still not cheap, but below median in some cases, and so the euphoria that's come with the technology sector and AI has really been a US phenomenon. The non-US markets have much less in technology and those types of stocks relative to other sectors, so we haven't seen that euphoria. The growth sector is a little bit more expensive. Ironically, also emerging markets is a little bit more expensive. But again, just interesting to note in stark comparison to the US markets. And if you'll go to page 18, we've talked a little bit about real estate and how it has had some rough times in this particular fiscal year. In the quarter, it seems like that is softening. You can see some other on the right-hand side, real asset performance. We have everything from REITs, which for the fiscal year did have a positive return. Commodities had a positive return. Global natural resource stocks did. And then the MLPs that you may have heard about, midstream energy transmission, up about 36%. So other real assets had performance that was a little bit stronger than the negative returns that we've seen in the real estate markets. Any questions on that before we move to section 2, page 4? All right. Page 4 in section 2 is the retirement plans, almost $15 billion in size. And the two largest plans, as you see, is the public employees at about $7.3 billion, and teachers, which is about $5.1 billion. On page 6, you can see the returns of the retirement plans. PERS is at the top, and then TRS follows. We show both gross and net. You see that 9.07% net of fees return. And its relative rank, we've been through the information on some of the introductory material, but as you want to look at the other pension plans and how they did, they follow on the next page as well. In fact, the next 2 pages. One thing that's very important is on page 9. We do rank your plans relative to others. We do have a peer group that we compare to, which is public plans over $5 billion in size. And the information at the bottom is interesting in that it shows our asset allocation structure versus those plans, those peer groups. And our US equity allocation is the green diamond on the left-hand side. You can see it's very near that median line. We have a very similar US equity allocation is the median plan in that universe. And our non-US, we call this global non-US, is just a little bit lower than the median, not significantly though. Our fixed income allocation is very similar to other plans. When we look at US fixed income, have slightly more in non-US strategies, but together have about the same as other plans in both equity and fixed income. Alternatives, we have a little bit more. This is really combining everything from private equity to private credit. And for other plans that have hedge funds, that's where that would be, is in that particular allocation. And we have 23 versus the median of 21.6. In this particular period, because we have higher private equity than some of those other systems, it would have hurt us if they had instead more public equity. But really one of the biggest differences relative to other plans is our real estate exposure of about 12.3% compared to the median plan at 6.7%. Here, we like the fact that real estate does have a very low level of correlation to the equity market. That's an advantage of holding real estate. We also like the cash flow that comes from real estate, that lease income that's passed through. But compared to other plans, that was one of the differentiators that created our below median ranking in this particular year. But over very long periods of time, we rank extremely well, as you'll see in some of the information at the top, where in the 3-year period, we rank in looking at PERS in the 27th percentile, 19th for 5 years, 22nd for 7 years, and 10th percentile for 10 years. And in this case, you don't want to be 100, you want to be closer to 1. So very good, very, very strong long-term rankings. Moving to page 11, and please stop me at any point. Page 11 actually shows risk and return. We'll actually look at this in our risk report again, but when we look over the last 5 years, you are the green dot or the green diamond in the upper left-hand graph. The gray boxes are other plans in that same universe we just talked about in the previous study of asset allocation. You can see our benchmark is the blue dot. We have public market equivalents of our private market investments in our benchmarking, and they have a lot more volatility than our actual private investments do. But when you compare that, we have a better return at lower risk than many of our peers and certainly outperform that same metric versus our benchmark, you're in really good shape here. If we look at the following page, that was for 5 years, we show you for 10 years, and it's a very similar story in terms of we're in that northwest quadrant in the green diamond, which is exactly where we'd like you to be, and that compares very well to your benchmark and peers. So page 13 are our pools. This is adding together the trust fund pool, STIP, as well as the CAP. That's on the next page. That's a full $26.7 billion as of the end of June. And then the pool performance is on page 14, which just follows. And again, we've been through that performance in our previous summary. Just a real quick reminder on page 15, and this of course is in your staff reporting, but the CAP, the Consolidated Asset Pension Pool, is on page 15. It shows you the various asset classes that it participates in. And if you add together domestic equity and international equity, you can see that's about 42% of our investments here. Real estate and real assets is about 18, private investments about 17, fixed income about 22. With that, I was thinking that unless you have questions, I'd just run you through the risk report for the first time. So that's a few pages back on page 24. So this report will probably continue to evolve as we think about additional things that may be helpful for you to track and think about as fiduciaries. This particular one, the first page in this section, is looking at 5-year rolling Sharpe ratios. So Sharpe ratios are looking at your excess return that you're earning relative to a risk-free rate, relative to each unit of risk that you take. And is that trade-off a good one? So if you look at these lines, there's a lot of lines here, and the public employee retirement system is in green. And it's kind of in the middle of all the other asset classes that you have in your portfolio. If you look in the upper right-hand section of this, these couple lines of numbers are the only specific numbers I'll run you through on this page. But if you look at the top for public employees, the annualized Sharpe ratios over 3, 5, and 10 years are positive. They're 0.3, 0.7, and 0.8, which beats public plan medians in each case. So you are getting better excess return for each unit of risk that you're taking on relative to your peers. The same is true if you look at net of fees, the return that you're earning, and calculate the Sharpe ratio of that versus your benchmark. You have better numbers in 3, 5, and 10 years compared to your benchmark. So that's really what to take away from this. And one thing I wanted to explain is, if you look at this chart and you say, well, tell me more about these lines. If our total fund is that green, acid green line that kind of goes through the middle of the other asset classes, what is going on with those lines that have great Sharpe ratios that are way above where our total plan is? Those are actual asset classes that generate a return without as much volatility day to day because of their pricing. So that is really real estate in our private investments. So you may say, gosh, well, is that really a realistic view of the return we're getting for each unit of risk that we're taking? Yes, it is an accurate view, but it is skewed by the fact that you don't have a lot of volatility in those investments when you look at how infrequently they're marked to market. So they're accurate, and they do contribute to the total result, but I just wanted to mention it's just because they aren't priced as often that their relative units of risk are lower.
On the Sharpe ratio, is there any way to have a goal? Is it just too out of control, kind of?
You want it to be positive over long periods of time and meaningful, but there isn't a specific goal just because the return that the markets will give you over time versus a risk-free is going to vary. Now, one of the things that you may have noticed is if you look back at the upper right-hand section under the annualized Sharpe ratios, one question I anticipated is that you may look at that and say, gosh, it was great for 10 years, and then it's less for 5 years, it's even less for 3 years. Is this a bad trend? Well, if you're being compared to how much you can beat a risk-free rate, what happened to the risk-free rate? It went up because interest rates are higher. So it's kind of an artificial result of the environment that we've been in, but isn't saying that we're doing anything less productive for the risk we're taking on. It's just that the risk-free rate has actually earned a pretty good rate of return for the last couple of years.
So the new actuarial requirements are you have to run risk-free rate and actual assumptions.
Yes. Mm-hmm.
So will they be skewed, will all of the pension amortization periods and funded ratios be skewed upward until the Fed reduces the risk-free rate returns?
When you look at the risk-free rate, what happens is when that number is higher, then you actually see that your liabilities are less.
Mm-hmm.
When it's lower, your liabilities are higher. So you will see a blip in the right direction as long as the risk-free rate is higher, but if it goes down substantially, the reverse will happen.
So Maggie, from a pension fund perspective, you guys are running that, but it's not really anything that's guiding decision-making. It's we're required to run this and it exists, but it's not useful for a management tool.
Yeah. And one of the things that there are various organizations that calculate that for public pension plans nationally. And, part of the concern was that when interest rates were basically zero, then it just made it look like liabilities were just enormous relative to the assumed rate. So it's mitigated somewhat or much less than it was because of the higher rates. And we don't think that interest rates are heading back down to where we were, but somewhere in between, so.
Could you give us the exact number that we're going to, so we can
When
plan
I come
around
back
it?
tomorrow.
Okay, thank you, thank you.
And when, right. Page 25. Liquidity is a risk that you should monitor as fiduciaries because you have a mature pension system, you're actively paying out liabilities. When you look at the liquidity by asset class, this is something that we like to keep track of. Actually, I'll point you to two different parts of this particular page. The asset allocation by liquidity is actually grouping in the lower left-hand section. It's lumping all of your liquid assets together like public equity and fixed income, your less liquid strategies and your not liquid strategies. Not liquid would be private equity, for example. So this just allows you as fiduciaries to show what trends look like and ask questions. We've brought our liquid allocation down over time in exchange for not liquid strategies like private equity to earn more than we could in the liquid markets. It almost does no good to just show you only a snapshot in time as of June 30 because you wouldn't know where that was historically. So this doesn't give us any conclusions about is this a great place to be or not a great place to be, but this is one of the outcomes of the asset allocation that is selected, and it's just important for you as fiduciaries to see what that particular quality looks like in the portfolios. If you look in the upper right-hand section, this actually shows you liquidity by asset class, so you can see what the components are of the liquid strategies. So you've got domestic equity, international equity, core fixed income. You would expect those all to be there. Very little in the less liquid category, and most of your other investments are in the truly illiquid or private investments. This doesn't mean that those investments don't pay out return through their life like private credit. One of the reasons we like private credit is that yield comes through to you as investors. You don't have to wait till the end of the life of a private credit fund to get the interest that has been earned in the life of that investment. So again, just things to note that we're watching. The only other piece of this page that I'll review for today on page 25 is the correlation matrix. We do look at the correlation of your total fund results versus various components or various major asset classes to say, what do you look most like in terms of how your returns materialize over time? And do we have some asset classes that we're exposed to or strategies that are diversifying our largely equity driven program? And here you can see strategies that are really capital appreciation or equity oriented in nature have the biggest similarity to our return, or said a better way, our return looks a lot like what goes on in the equity markets. And this is not a surprise. I'll show you another page that shows you why this is true. The following page is page 26. It's risk and return over 5 years. And we show you total fund risk and return that we just went over a few pages ago. But here we're actually showing you by asset class what the risk return is over the last 5 years. And first of all, your total fund is in the middle. You can see the all public pension plans over 5 billion. That's that dark diamond. The lighter gray diamond just to the left of it is the public employees' retirement actual results. And then gross of fees, that's net of fees, and then in green is the gross of fees that you can compare to all public plans. Now, if you look at all the tools that we use to generate those returns at the total fund level, it's very interesting to note that domestic equity and international equity had similar types of volatility at about 18%. We know that, we expect that, they're mark to market daily, they tend to have some of the highest volatility compared to core fixed income. The return of core fixed income and volatility of core fixed income is very low. Cash is very low. Real estate, if we look at the last 5 years, you can see that it's generated a return with a low level of volatility. That isn't because there isn't risk in fixed income. It's just that those buildings don't get marked to market every day. They get marked to market generally on a quarterly cycle. And when you look at real assets, they're kind of in the middle of the page. Private investments, which is private equity and private credit, they have a very low level of actual volatility, but an attractive return. Again, that isn't because that there isn't any risk in private equity and private credit, it's just they don't get marked to market every day. So it's interesting when you look at the individual attributes of every kind of asset class that you have, they're all quite different. And they contribute to that total fund result over the last 5 years. If we saw something in here that looked unusual, because this is in your risk report, we would call it out to you, but all these relationships are exactly as we would expect. I'm drawing close to the end here. I know you're getting tired of listening to me. Couple of other things we look at on page 27 is for 5 years looking at risk and return. We've already seen that in the total fund. In the upper left-hand side for the public employees plan. If we look now at what our return experience has been in up markets versus down markets, you really haven't seen this before. When our public employees benchmark is either moving up or moving down, in other words, the markets that we participate in are moving up or moving down, what does our return pattern look like? And when you look at this, you have built a plan that loses much less on the downside than the benchmark itself. Part of this is because of the way we benchmark our private investments relative to the public market. So using small cap to benchmark private equity, because there really isn't a good, different strategy there. But by design, for a mature pension plan, this is a nice result to have, to lose less in the down markets and to participate in the up markets. So you can see that we had a return over 14 up quarters in the last 5 years. We had a return that was just 64 basis points shy of our benchmark, but we actually saved about 1.5% on the downside. So again, just characteristics of the way that the plans are invested. 2 more pages, again on the theme of risk on page 28. I have mentioned in passing that a lot of our portfolio volatility is from our equity investments, our public equity investments. And in fact, if you look at this particular chart, we have contribution to volatility. This is contribution to how much your total fund moves around. 55% of the volatility movements in your total fund is explained by your domestic equity portfolio, yet your current midpoint for domestic equity is only 29. This is almost identical in almost all plans that we run this chart for, is that most of your volatility is coming from equities, and it's coming at a level that's much greater than your actual allocation to equities. If you look at international equity, it's the same kind of story, just a little bit less. Your midpoint is 15% for international equity, yet your contribution to volatility over the last 5 years, about 26% of it's coming from international equity. So almost a double in terms of how much it's contributing to risk. And in stark contrast to that, look at your core fixed income. Your midpoint in core fixed income is 14%. It contributed only 5% to the volatility of your total fund. That is diversification because it is earning a rate of return with less contribution to volatility. And there's other examples of this as well, but it's just interesting to note that whenever we do an asset allocation, one of the things we know we're trying to do is to balance the volatility that equities bring to our total fund. We must have them, we need them to generate return, but they do move our return around a lot. Last page, page 29, this is another way of saying the same thing. On page 29, we have correlations. How much do these markets move together? And if domestic equity and international equity, let's use domestic equity for simplicity, if it's really driving a lot of your total fund volatility, is there any investment that you have that really moves a lot differently than domestic equity to help us mitigate that contribution to volatility? And as you look down that first row, the tallest row on the left-hand side of the chart, the asset classes that have tended to help most diversify our domestic equity risk has been cash, real estate, and actually your private investments, and a good deal of that is due to private credit as well as private equity. So it's important as we construct asset allocations, and we'll have future meetings where we talk about conclusions for the year and John's forthcoming reports, is that we do look at, at the end of the day, when we diversify into these other strategies, do they really behave differently than equity? Because we need some of them to provide that diversification of return experience. And this is showing you your actual results of investing in these various markets is providing some of that diversification. So that's your first snapshot of risk and some of the things that occurred to us as good themes for us as a board to visit on each time we meet. It won't take so long in future meetings, but I just invite you to continue to digest some of these measurements. We will show those trends through time, but there isn't anything as I look at this set of risk measures, and there are others we could show you. There's nothing that's jumping out to me as unusual or unexpected for your risk-related results.
Okay. Well, that's a lot of information, that's for sure.
It is. It is.
Any questions for Becky?
Just a question for the board that's, don't need an answer now, but as you look at this new risk report, if there's elements you don't see or elements that you'd like emphasized and explored in more detail, please let Becky or me know.
Yes.
We're gonna fine tune this over the next while to be a useful tool. So please deep dive and let us know where we can be more thorough.
Well, it's an important topic, that's for sure.
It is.
Okay, no questions, Becky, thank you.
Thank you.
I guess we're moving along here, so investment update.
Okay.
We saved the best for last, or?
Yes.
Sure. All right, thank you, Mr. Chairman, members of the board. I am on page 4 of the investment update under tab 8. So, as we were talking about a bit before, I was writing this in mid to late July as the sky was falling in the markets and everything was going wrong apparently, and then suddenly the skies cleared and we're just completely fine again, unless NVIDIA's earnings are not good this afternoon, in which case we'll all panic again, I suppose, I don't know. So, kind of an up and down theme here recently. The market has been swinging between kind of euphoria and despair fairly regularly, it seems like anyways. Well, when we look at the metrics, and Becky touched on a number of these already, so I won't hit this too hard, but GDP looks pretty good. As of Monday, the Atlanta FedNow forecast that they do is sitting right at 2% GDP growth going forward. I would say that's, normal effectively. Retail sales have looked pretty good. They were strong in both June and July, which, continues to surprise a bit, I guess, in terms of the strength of the consumer overall, but, that's not bad news necessarily. Housing has certainly been one of the standout, probably weak points, particularly existing home sales, but not exactly a shock given where rates have gone. Obviously, owning a home and particularly a mortgage is significantly more expensive than it used to be. But we've already seen, rates, 30-year rates and things start to roll over a little bit in anticipation of the Fed cutting rates, which they pretty much said they're going to do at the September meeting. The pace and timing of that is pretty much TBD, data dependent, but you know, I think we're certainly at the end of the hiking cycle, starting the cutting cycle, and we'll see where that goes from there. Slide 5, you know, again, just kind of showing, which I've shown this type of stuff a number of times over recent quarters, you know, job openings and the quit rate fallen off considerably from where we were at the highs, but when we look at a kind of a longer time frame, we're, you know, still maybe a little above pre-pandemic levels, or at least kind of on par with pre-pandemic levels, so it doesn't look too bad. I think the July job numbers report that we get, not this Friday, but next Friday, will be a big one, given that the Fed will be watching that closely, I think, to see if, you know, we continue to lose jobs. It's obviously slowed. We had it was 114K last go round, you know, which is steadily declined. So if we saw a steep decline there or something, maybe they'd get more aggressive with the rate cuts. But at the moment, things look decent, I would say. Slide 6, you know, similar theme here, and I've shown this in the past as well, but the services, the ISM Services Index has certainly trended weaker over the last couple of years, but it's still in positive territory, generally speaking. We got a similar version of this from, there's an S&P ISM index that we got last week. It was also kind of still in growth mode, above 50. All ISM indices, if they're above 50, it indicates growth. If it's below 50, it indicates contraction. Manufacturing, on the other hand, has been weak and is below 50, has been in contraction territory. However, as you know, the US economy is largely driven by the services industry, so you know, growth in services tends to portend pretty well overall for the US economy.
Can I ask a question about, like, back on page 4?
Sure.
Think about personal debt, family debt or anything, is that something you look at?
It is, so that has been ticking up a little bit as, you know, you kind of had this big wave of COVID savings, basically CARES Act money that went out, et cetera, to people, so the savings rate went way up, kind of in that time frame where we were all getting checks from the government for a little while, and then that has slowly started to roll over and is I would say pretty well spent down, and so we've seen credit card debt and things start to come back up, but I haven't looked at it, you know, real recently, but if memory serves, you know, we're probably, you know, closer to levels that I would say are more normal for longer time periods. We are not at, you know, significant highs. Default rates have started to come up a little bit in cards and things, but again, you know, kind of a normalization probably from what they were prior. So nothing there that would spark significant concern at this point, but yeah, definitely something that we keep an eye on.
Thank you.
Okay. So slide 7 kind of does a lot of stuff that Becky talked about already here, but the S&P 500 looked pretty expensive, or looked expensive at quarter end. It looked a lot cheaper there for just a little bit, you know, late July, early August, and now we're back to the same levels essentially that we were at prior. So as of today, I would say we sit at a very similar spot, lots of volatility over that time frame. You know, main point I guess I would say here, just in terms of kind of how we've been thinking about things is, and Jason's talked about it, I've talked about it in prior quarters, you know, Becky just talked about it, the handful of big large cap stocks that are driving the S&P 500 index, you know, that are a huge weight relative to what they have been over history. So kind of pushing against that a little bit, we've kind of been a little bit overweight small caps for quite some time. We've stuck with that. Hasn't worked for a while. You'd have rather owned the S&P 500 and just been all in on NVIDIA and Apple and whatnot, but you know, that's kind of the positioning that we've taken, and we've been a little bit underweight public equities, you know, kind of because of this trend. So shying away particularly from domestic equities, being a little bit underweight, our midpoint, you know, call it a couple percentage points, So that's just kind of been a, really evaluation metric there. And as we've talked about before, when I'm looking at, okay, I need to pay benefits, or I've got capital calls coming from private equity, private credit, whatever, I'm likely, when things look that expensive, to take it from domestic equities, all other things being equal. Conversely, on slide 8, obviously bond yields look quite a bit more attractive compared to the last decade anyways, and that's obviously because we had virtually, 0% interest rates for a very long time. And we've come up significantly as the Fed raised rates dramatically, and starting in 21. So, probably been a little bit biased towards taking, any extra cash that we might have and putting it maybe into core fixed income or EMD, some of those types of things over the last, several quarters, maybe 2 years or so. Not that we're dramatically overweight there or anything, but I've edged that way just a bit because of those types of things. Obviously, with an actuarial hurdle of 7.3, when you can get, 5, 6, 7% in some of these fixed income areas, it doesn't look too bad. So, questions about any of that before I jump forward here? All right, seeing none, slide 9. Total assets under management by asset class, a little over 28 billion as of the end of the quarter. Nothing really dramatically different overall here in terms of the breakdown than what we've seen previously. Similarly, slide 10, same slide, but by participant type. Again, no real big changes here as you would expect in terms of the names that you might see here on the page.
John, I have to compliment you on your color scheme. Thank you.
That's Matt. I asked him to try to clarify it a little bit for us. He did a good job.
Well, I appreciate it.
Good. Slide 11, assets under management by pool. Again, nothing really unique to say here other than, as we've been talking about, STIP's probably stayed higher than maybe we would have expected, but not necessarily complaining, and it's still earning quite a good rate. So thanks to the fixed income team, we'll keep it rolling. Slide 12, turning to the pension in more detail, well within all of our approved asset class ranges here. As I noted, we're a little below the midpoint in domestic and international equities, a little more so in domestic than international. Slightly over the midpoint in private investments, real estate, and core fixed income. Probably have moved that direction even a little bit more in the fixed income space since these numbers at the end of the quarter, probably a little further over in core and a little bit over maybe more so in non-core as well.
So John, I know it's too early for asset allocation discussion, but on in the last few years, we've been fairly stable. Do you see that in general continuing?
Yes, by and large. In terms of the asset allocation, yes. I mean, I think we've made some pretty significant moves, as some of Becky's slides kind of showed, where we kind of dipped in fixed income when we were still at 0 rates, and then as rates have climbed back up, you kind of saw some of that back into fixed income a little bit. So a few changes probably, Jack, but very, very much around the margins. And I think, not to front run the October meeting too much, part of the discussion we had when we were in New York with everybody was, I think we're kind of there, so when I bring the asset allocation this go round, we've kind of ramped up over time, some of the private stuff, some real estate stuff, things like that. I think we're kind of there, so when we think about, and when I think about at least the liquid, illiquid mix and, how all that shakes out, I don't see too many changes, going forward. I mean, never say never, we'll keep looking at it every year, but, I don't think, at least on the pace that we've increased some of those various areas, that would continue.
Good.
Slide 13, the asset allocation for pension as of the end of the quarter. Again, no real big big changes here from what you've seen in prior quarters, well diversified across all the different asset classes. Slide 14, our overall performance in terms of dollar value add and our net cash flows. As always, good to see that we've added more value than we've had to take away in order to pay benefits, particularly over the longer timeframes. Our net cash need has been much less than what we've managed to earn in the portfolios over a long period of time, so we continue to grow the overall size of the pension portfolios. It's a good place to be. Slide 15, performance, as Becky talked about, fiscal year to date, a little over 9%. Very happy with that, well in excess of our actuarial hurdle. And the longer term numbers in general look very good as well, in excess generally of our actuarial hurdle. And I would note that the since inception number all the way out at the far right is actually a 30-year number this quarter. So at 7 3/4 for the two larger pension plans and slightly below that for the others, that's pretty good over the long term. And I think, not that I've done the math, but I think hits our actuarial hurdle regardless of what that was over time, as obviously that's come down, but highest it was in my memory was 8%.
We were at
Quite
8.
some time, and then we went to 7 3/4, and then 7 6/5, and 7/5, and then 7/3. So I think we managed it long term. Looks good. Slide 16, as we turn to assets outside of pension, again here, the normal cast of characters within the various funds that we have for separate accounts. I don't think anything has really changed there. Slide 17, STIP, fixed income did a great job of walking through that, as Kirsten noted, 54 days here in terms of our weighted average maturity at the end of the quarter, but she has lengthened that some in anticipation of the decline in rates. So I'm trying to lock in to the degree that we can in STIP, a little bit higher rates there. So that's great, 8.8 billion almost. Definitely not a small number in STIP, lots to do. Performance overall has been good. Obviously, as they talked about, nice increase in the more recent years, 5.5% in STIP is pretty good, but would expect that to probably start rolling over a little bit if the Fed starts cutting rates. What the pace of those cuts are, we'll see. TBD. Trust fund on slide 19, again, in all of our approved asset class ranges here. We continue to look for opportunities, probably particularly within real assets and real estate, to maybe find a few opportunities there, but other than that, probably right around where we're gonna be. Slide 20, trust funds performance. Again, I would point you to the bottom section there where it says yield, the 1-year yield at 3.83%, higher distribution in terms of the cash flow that the participants are getting. That's been going up as they are able to reinvest at higher rates. And ultimately, as fixed income kind of talked about, that yield, that higher yield that we're now getting in the portfolio will eventually make its way through into the performance number, but that's kind of lagged, but probably not really what our participants care about. They care about what are they gonna get in terms of cash flow in a given year. And that's been going up.
Maybe just quick thing, John, if you look at the 5-year and you see the dollar value add versus the net cash flow, we've had net cash flows into trust fund as we've been working with the participants. So treasurers fund, health pools, various others have been buying in. And so some of the commentary we're getting right now is if you look at that 1 year on page 20 versus the prior page 18 on STIP, they're looking at, I could have got 5.5% in STIP. But if you look at the 5-year, you're looking at a 1.15 versus a 2.27 for yield. So Longer term, STIP 165 versus 247, inverted yield curve has been hard to explain to people who just look at what's my monthly distributions. But it's been very lucrative and we were able to get more into the pool. It's a question of, now that they
very happy down the road.
yes,
They just don't know it yet.
yeah, exactly. So sorry.
No, totally fine. State fund on slide 21, again, well within all of our approved asset class ranges. As we've talked about there before, continuing to try to find places to increase our allocation to real assets there, but it takes time to get money in the ground. Feel pretty good about where we're at. The transition to the full ag index and lengthening duration there, similar to the comments Dan just made, that has worked out really well and they will be happy about that in the long term as we've been able to, lock in some higher yields there and the timing of that. As we've gone slow, we've lagged into that, but that's worked out really well in their favor. And you can kind of see that on the next page on slide 22, performance across all time frames versus the benchmark has been very favorable. So yeah, all's good there. Questions on any of the various portfolios before I keep going? Okay. On slide 23, inflation's been slowly declining, economic metrics are weakening, but I think overall, it seems like the Fed may be pulling off the impossible and bringing things into a soft landing. Knock on wood, I guess. They've indicated very strongly that they will start cutting rates in September, whether that's 25 basis points or 50 or what have you. Who knows and what the pace is going forward. I think they'll be very data dependent. I don't think they'll go quickly unless, things really start to fall apart more so in the economy. But that's just, that's my view. The market seems to think that they're gonna go a bit quicker than I do, I guess. But they, as we've talked about in prior quarters, the market has consistently been wrong about that and over optimistic about how quickly they're going to cut. In July, we launched our co-investment program for private equity. Thomas will talk about that a little bit more when we get to his section, but recall that he and Ian had talked about that a bit in the deep dive previously. So, co-investments, we're investing alongside our existing managers in same deals we'd have in the funds, but we get to do that at zero management fees, zero carry. So the fees are much, much less. In order to do that, we have hired Fisher Lynch to help us with that because you need to be able to turn those kinds of opportunities over quickly. We do not have the staff and things to do that, but and Thomas will talk about that more in his section, but we're excited to finally launch that. We think it's a really good thing that we hadn't been taking advantage of previously, and we think it's a good, it's a good fee savings thing at the end of the day in managers that we already have confidence in. We met with RBK in New York a couple weeks ago, talked about asset allocation. I think that all went very well. We had a good conversation not only about asset allocation, but about a number of other topics, and it's just nice to get everybody in the same room and not be in an open boardroom setting, and we can say, whatever crazy thing pops into our head and discuss that and go through it, and it's always a valuable process. So more to come on that at the October meeting when I make the recommendation for any changes to asset allocation. State Street Triennial meeting was last week here. We continue to look for ways to improve that relationship. We did lose Travis, for those of you, Maggie might remember from the RFP. Travis was one of our long-term relationship managers, kind of the head guy for that. He got another job, another opportunity with the university system in California, and good for him. We met the new person at this meeting, Bill Claxton, he's his replacement. He does have 30+ years of experience in the industry with a few different custodians. So it's not as if we got a newbie or something like that. He's got some pretty long-term deep experience, so that was good. And we are pushing a few automation projects forward, kind of with, mostly with accounting and ops, with fixed income chiming in a little bit, but I think we can get some efficiencies with a few things that we found there. As we talked about earlier a little bit, I think a very successful summer with our interns. They did a lot of great projects for us. I mentioned Rob oversaw the interns. I think that went really well, probably because he'd been an intern, so he maybe knew the things that he should help them out with and all of that good stuff. So we will continue to do that in the future, which is great. And then finally, both Willie and Sam have been promoted to a level 2 analyst. Remember our PGP matrix. This isn't because of this per se, but also wanted to note that Willie passed his level 2 of the CFA exam, which is the really hard one in most of our opinions that have a CFA. That's the real difficult hurdle, so good for him. And Sam now has 2 master's degrees because one wasn't enough. Kind of greedy, but she got her MBA earlier this year and then her Master of Finance just recently. So I think she's probably relieved that she doesn't have to do any more tests for a little while, would be my guess as I've talked to her. And that, I think, is it for me, unless you have any other questions. You can turn it over to Aaron.
Good afternoon, Mr. Chair.
Hey, just a second. I don't know about you guys, but I need a stretch break, maybe just 5 minutes. We want to be awake for your opinion.
We got questions.
It's a good idea. I don't want to put
There's a lot of information that's coming.
So just, not long, but 5, okay. Get started. I guess we got Maggie's approval on the brakes. So it's all yours.
Alrighty, so macro attribution, it's correct, it's not the most exciting topic, so it's probably good to take a break. And it is made less exciting by the fact that we're looking at a longer term 3-year, so this really doesn't change very much from quarter to quarter, as you may or may not have noticed. So starting off with strategic asset allocation, which is the performance of our midpoint weighted benchmark. So had we been invested in our benchmarks at the midpoint, we would have earned approximately 3.1%. So moving on to tactical asset allocation, we've primarily just been selling equities to fund the pension net cash need of about $400 million this last year. And putting some of the extra proceeds into the fixed income asset classes. In aggregate, the overweighting, underweighting of the asset classes relative to their benchmarks decreased the pension return by about 13 basis points. And largely, those overweighting, underweightings are largely frictional, with the exception of some maybe very small active underweighting or overweighting in the public equity asset classes. I'll skip over style selection unless there's any questions. These really have not changed much over the last quarter. So moving on to manager selection. Within international equity, growth manager was the primary contributor to the manager selection underperformance of about 7 basis points. I didn't make a bullet for this, but I think I should have. So within core fixed income, our internal portfolio added about 7 basis points of outperformance at the pension level, which is pretty good. Private investments was the main contributor to the overall manager selection effects, with both private equity and private credit making contributions. Within real assets, there was 21 basis points of effects, with infrastructure providing almost all of it, and that's both the public and private infrastructure managers. As a reminder, within real assets, we have the kind of the sub-asset classes of infrastructure, commodities, and TIPS. And commodities is broken down even further into energy, timber, and broad natural resources. Within real estate, the private partnerships, our CMBS manager and REIT manager all added positive effects, totaling 46 basis points. If there are no questions, I'll pass it off to Jason.
Question? Okay, he explained it well. Now this is the most exciting thing.
Good afternoon, Mr. Chairman, members of the board, starting with domestic equity on page 27. Large cap growth stocks outperformed again in the second quarter. This has been a familiar theme, not just recently, but this has held true over the last 5 years and 10 years. But there has been more going on under the surface recently. Not every Magnificent Seven stock has been magnificent year to date. It's really been one stock that has driven the returns within the group this year. And two, as we've gotten closer to expectations that the Fed will be cutting interest rates, we've seen a rotation into small caps and value stocks. So while there may be more uncertainty about the strength of the job market and the economy, the S&P 500 revenue growth has strengthened, and consensus earnings estimates are still calling for double-digit earnings per share growth this year. Turn to page 28. Again, as a reminder, we are 100% indexed or passive in domestic equities, so the sector differences of our portfolio versus the asset class benchmark are very small. And in the bottom right-hand corner, you see our positioning in small caps. We maintained an overweight to small caps, and the size of that overweight has been consistent in recent quarters. Page 29. So the rally that really started in late 2022 has been driven really by higher valuations. So S&P 500 forward PE is currently around 21 times as compared to about 15 times where it was in late 2022. And as I mentioned, consensus expectations are for double-digit earnings growth this year, which will be the strongest since 2021. We've talked a lot about market concentration. Market concentration of the largest stocks is still high. It's come down a little bit recently. The top 10 stocks at the end of the second quarter was 37%, and maybe even more eye-popping is the top 3 stocks account for 20% of the S&P 500. Any questions about domestic equities? All right, moving to international equity on page 30. Double-digit returns for international equities over the last year, which is nice, but you can see how international stocks have lagged U.S. stocks over all these time periods. As we've seen in recent quarters, the dynamics in international markets have differed from those in the U.S. Value has outperformed growth over the last year. Large caps have outperformed small caps, but by a relatively small amount. And after having lagged for some time, through the end of the second quarter, emerging markets have outperformed developed markets this year. And this last point about the dollar, it's an important one, especially as we get closer to the Fed cutting interest rates. So we measure our returns in US dollars, and the dollar has been relatively strong for a long time. And the Fed having kept rates, interest rates high has put upward pressure on the US dollar, which has been a headwind for international stocks. As an example, year to date, the broad international equity index is up about 11% in local currency terms, but only up 6% in US dollars. So generally speaking, a weaker dollar should provide a tailwind for international stocks. And this is what we've seen recently as the dollar has weakened in the third quarter, and international stocks have performed better. Page 31. In the upper left-hand corner, you see our position in emerging markets relative to developed markets. So our position in EM has shifted from having been slightly overweight last year to now slightly underweight. The reason for this largely is that earlier this year, we gave our active managers more latitude with respect to their weight in emerging markets relative to their benchmark. So this is not something we are actively managing. This is something that is a result of the decisions of our active managers. In the bottom left-hand corner, you see the slight small cap overweight. And in the bottom right-hand corner, you see the split between active and passive. Our weight in active management has risen for a couple of reasons. One is that we've used our index funds for liquidity. So when we sell out of our index funds, our passive exposure comes down. And two, we've made contributions over the last year, made some last May and September to active managers, and that number will increase a little bit here in the third quarter as we made another contribution to our active small cap strategy. Page 32. PE multiples for international stocks have been the driver of the rally that started early in late 2022, but not to the extent that they have in the US. I mentioned in past meetings, but the discount the international stocks trade at relative to US stocks, that discount is at a historical high. It was 36% at the end of June. It's dropped a little bit here in the third quarter. But as a comparison, in late 2022, that valuation discount for international stocks was about 29%, and that discount has steadily increased over the last couple of years. Any questions about international equities? All right, moving to non-core fixed income on page 33. Overall strong returns for non-core fixed income over the last year, and in excess of our actuarial hurdle, which is nice. Preferred securities was the top performer of the last year after having lagged early in 2023. Remember the banking crisis that we had early in the first quarter in March of 2023. High yield has also been strong, while emerging market debt and convertibles have lagged. And going back to the performance of the US dollar, so a weaker dollar would generally be good for emerging market debt, and that's something we've seen so far in the third quarter, as we've had a little bit of weaker dollar, and emerging market debt has been the strongest performer in the asset class. With respect to high yield, each of our high yield managers outperformed in the second quarter, but the general theme in high yield over the last year has been outperformance by lower quality credits, and these types of rallies, strong risk on rallies, tend to be more difficult environment for managers to outperform, given that they tend to have more conservative positioning. Page 34, you see on the left-hand side of the page, sector differences that really reflects the exposures to our strategies outside of the US high yield, so preferreds, emerging market debt, convertible bonds. Those exposures also give us a higher credit quality profile, as you see in the upper right-hand corner, as preferreds and emerging market debt have significant exposures to investment-grade securities. In the bottom right-hand corner, no significant changes really to our allocation within non-core. We did add some to our convertible bond manager in the second quarter, and here more recently in the third quarter made another contribution to our emerging market debt portfolio. Page 35. So this chart may look a little bit different next quarter. There should be a little blip there on the right side of the page, as we had a brief widening of high yield spreads early in August. They've since compressed. They come back down really to close to the levels where they were before the market volatility that we had earlier this month, but at a level that we would consider relatively tight versus history. And just a few comments on the high yield market. It's a healthy market, high quality relative to history, so a high percent of double Bs, which are higher quality bonds, and a relatively low percent of triple Cs, which are lower rated credits. And new issuance has been heavily tilted towards refinancing and paying down debt, as opposed to companies actually increasing leverage. Default rates have been low. That's expected to increase some, but still at a low level, at or below long-term averages. And importantly too, the market's been open, so companies have been able to come to market and address their upcoming maturities, which has played a factor in keeping default rates relatively low. Any questions about non-core fixed income? Thank you.
Hi, everyone. Mr. Chairman, members of the board, hope everyone's had a nice summer thus far. I'm Ethan Hurley, and I'll be covering off real estate and real assets over the next few pages, starting on page 36, where you will see some familiar scenes here. Our assets under management by entity in the upper left, value add in the upper right, performance immediately below, and some comments relative to the real estate market. A lot of this hasn't changed. There continues to be price dislocation. Transaction volumes remain depressed, but relative to recent quarters are picking up, which is a good sign. Fundamentals are mixed depending on the property type and location. Debt is still and remains available for the right properties in the right locations. There's been concern over distress and refinancing in this higher interest rate environment. That's been addressed through distressed sales, though muted relative to the GFC, for example. The cliche that is extend and pretend, loan modifications. Hopefully with this forecasted interest rate cut, that will lend itself to some increased confidence in the market, some clarity, hopefully some price discovery, increased transactions, and an eventual mending, healing of this otherwise protracted down cycle that we've seen in the real estate market.
What is pricing dislocation?
There's a bid-ask spread, so the buyers or the sellers want to sell up here and the buyers want to buy down here, and there's a big gap between expectations, which is leading to this extremely depressed transaction volume market that we've seen over the last 24 months.
Thank you.
You're welcome. Any other questions? Seeing none, we'll turn to the next page. In the upper left, you'll see that the real estate asset allocation is within all of its defined ranges as per the investment policy statement. We have property type diversification in the upper right, and private real estate cash flow behavior and NAV and commitments through time. Happy to answer any questions with regard to any of these charts. With none, we'll move on to real estate valuation. I've presented this in the past. This is Green Street's commercial property price index. I would address your attention to the past month column where you'll see some positive numbers, some neutral numbers. It feels like we're getting close to the bottom. That's about all I can say. There's some positive momentum here. Again, with this interest rate cut, that might portend some interesting things and start getting us on the path to recovery. But time will tell. I'm happy to address any questions as it relates to commercial real estate valuations, property types, fundamentals relative to a specific property type. Otherwise, we can move on to the next page where we'll cover off new commitments. And as you'll see on the next page, we have made one commitment since last we met. That was to Walton Street's Real Estate Debt Core Fund. $100 million was committed from CAP alongside a $50 million commitment from Trust Fund. Walton Street is a manager that we've known for a number of years. Like them a lot. They have a debt and equity side of the shop, which we really like. If something goes bad on the debt side, they have the operational expertise to take ownership of the property and actually operate it. They've been in business for over 30 years, have a lot of gray hair, have been through multiple cycles. They're 100% employee owned. We participated as a founding LP in this particular fund offering, which provided us the opportunity to take advantage of some very attractive founding LP economics, which you will see in the board brief vis-a-vis the management fee, which we will enjoy in perpetuity, and the carry, which we will also enjoy in perpetuity. It will focus on lending to core and near stabilized core assets in primary markets with a
particular focus on industrial and multifamily. And with that, I will open it up to questions.
I noticed, that you got an office in Mexico City. How much is done in Mexico?
If memory serves, it's on order of maybe $1 billion or $2 billion in equity. They have a separate and distinct team down there, largely multifamily and industrial. It's been in operation for 15 plus years. Very different from what we do with them.
Okay, so that was the main.
No Mexico exposure with this or this fund or the other fund with which we have exposure. Any other questions? Seeing none, we'll turn to page 40 and go over real assets. Again, AUM by entity, upper left, value add, upper right, performance immediately below. Some bullet points around oil, housing, lumber, aggregates. Happy to address any specific questions around energy, around our exposure, around our strategy in the real asset space. I won't redo the bullet points. Okay, you guys taking it easy on me. Page 41, you'll see in the upper left, we're within our established ranges as defined by our investment policy statement. You'll see our geographic diversification in the upper right. And again, our private real assets, cash flow, commitment, NAV behavior through time. Any particular questions? Okay. So on page 42, the top chart, I continue to present to you the oil price behavior through time. You can kind of see it's been trading within a range recently. A lot of stuff going on in the oil market. Happy to chat. I've sort of addressed it with the bullet point there. At the bottom chart, we switched it up a little bit. Instead of showing you the price of lumber, we threw in the price of aggregates and consumption through time. And this is kind of cool, and this is a big part of the reason why we made a sizable commitment to a strategy that's focused on investing in aggregates. Because you can kind of see that through time, price just continues to grow. Consumption generally has a nice positive growth trend through time. So hopefully you guys like that change. Maybe I'll stick with these two through time. Maybe I'll switch it up and throw a curveball here and there, but nevertheless, here it is. Happy to answer any questions. Seeing none, we'll go to the new commitments page where I'm going to turn it over to my partner in crime, Rob, who will tell you about our recent commitment to Copenhagen Infrastructure 5. Thanks for your time.
Thank you.
You bet.
All right. My name is Rob Sampson, Chairman, members of the board. I will be covering our, as Ethan noted, our recent commitment to Copenhagen Infrastructure 5, which was made on June 12th, 2024 for 75 million euros, which is, as of that day, about $82 million. This fund has very market standard terms and represents our second investment with a manager that we really like. CIP is a global firm with an industrial heritage, vertically or fully integrated investment and asset management teams. And they've been focused on the development of energy infrastructure since their inception in 2012. We expect and Fund 5 will focus on the same. And we expect that this fund will produce very long-dated, uncorrelated, and stable cash flows that will be accretive to our actuarial rate of return. I'll leave it there. If there are any questions at all on this strategy, I'm more than happy to field them.
When I look at these things that we've had in the past and look at good IRRs, how much emphasis do you put on past performance and a good IRR that we've had with them?
The past performance is always something that we take into consideration, and we put a large amount of value on that, especially relative to the actual rate. this particular fund, given the long dated cash flows, is something that we put a lot of value on. Any other questions? Hearing none, I will pass it off to Thomas to talk to you guys about the privates.
Thanks, Rob. Good afternoon, Chairman, members of the board. Thomas Winkler, Director of Private Investments. Walk you through a handful of slides on the private investments portfolio, and I'll start on slide 44. Ownership breakdown, as you're well aware, as of now, we're still just in cap with about 2.5 billion in assets. Performance on the slide, I know you can read, just quick note, short-term performance is within expectations. As you know, it fluctuates quite a bit, and I'll always try to draw your attention to the longer-term numbers, 10 years, handsomely outperforming the benchmark. Very comfortable there, and that's exactly where we want to be. Any questions, comments on that particular page? I'll keep moving along. Slide 45, the characteristics of the portfolio. Again, well within our policy dictated ranges in the top left-hand chart. The strategy breakdown on the top right, about 3/4 equity investments, 1/4 in credit. That's where we see the longer term for this portfolio, unless there are dramatic changes in the environment. But we feel equity heavy makes sense in the private investments, but we do have the quarter allocation to private credit, which has performed really, really well, as you know. On the geographic diversification, bottom right-hand chart, as you're well aware, it is a US-centric portfolio, will remain a US-centric portfolio, and that 80-20 split roughly is probably where we're gonna end up in the long term. I don't expect any major changes. We'll bounce around a little bit, maybe it becomes 15 or 21 international, but don't expect any major changes there. Any comments on that particular? I'll move right along. Page 46, our valuation or market environment slide. Just a couple of notes here. We have seen an uptick in deal activity in the buyout markets. Definitely even noticed more new deal announcements in our portfolio coming from our managers over the last couple of months. And you see on the left-hand side that 2024 is only the first 6 months, and the second half of the year tends to be a little bit stronger in terms of deal activity. So we are on pace to outpace 2023 deal activity in buyouts, which is good to see, a refreshing kind of bounce back from the slow year that we had last year. Second note I wanted to make, lending markets also have opened up back up a little bit. Access to capital has improved, and that is reflected in the increased deal activity that we're seeing. On the right-hand chart, light blue, that's the debt level or leverage use in buyout market and buyout deals. And you see that has come back slightly from previous year. That was the historic low. Again, access to capital has improved, so folks are able to put a little bit more leverage on the deals. We're still far below the long-term average, so not a concern there that people are over-levering the deals. And then just one comment I always like to make, as you're well aware, our portfolio by design focuses on managers that are using less leverage to begin with. Our managers tend to be less, hinging on financial engineering and debt, and rather focusing on operational growth, operational improving, and organic growth in the companies. So our manager on average, at least a turn, if not two, lower than these headline numbers that you might see in the press somewhere. Any particular questions on that slide? I don't see anybody. I'll move right along. 47. Our new commitments, and as you can see here, we're actually spanning 2 fiscal years. That's why we've broken it out in these little sections. Wrapping up fiscal year 24, you see one more new commitment. That was Builders Venture Capital Fund 3 for $40 million. That was a re-up. It's a long-standing existing relationship for us. We're investors since Fund 1, early stage VC fund. We like the team. And that actually closed out our fiscal year 24 commitments at about $420 million for the year, right in line with our pacing assumptions. Fiscal year 25, 2 new commitments to date, many more to come. One of them was 10X Capital Partners Fund 4, also a re-up, long-standing relationship for us. We're investors since Fund 1 with the team. It goes right in line with, right in hand with the comments I made on the previous slide, operational focused, conservative use of leverage, buyout manager, employee owned, we really like them. It was a $50 million commitment, as I said, to re-up there.
How come their IRR is 117? Do we expect that?
Oh, yeah, that is guaranteed, no, of course not. That is early days, it's an early vet markup from one of the deals, as you're well aware, that is not going to persist. I can promise you that the 117 will not be there forever. We expect that to normalize, but overall performance is very strong for that particular manager. And then the last new commitment, Fisher Lynch Bighorn Investment Fund. Dovetailing on John's comments, that is our kickoff to our co-investment program. We made an initial $100 million commitment here for that this fiscal year. And unless there are any specific questions on this particular slide, I will segue right into the board brief for Fisher Lynch to give you a little bit more background there and on that program, if that makes sense. Maybe I'll take it a step back actually, and if you recall, October last year, Private Investments Deep Dive, we talked to you about that we wanted to do co-investments, what co-investments are, how we're going to approach it, and how we are able to tap into that market. So just as a reminder, co-investment ultimately is just a direct equity investment in a specific portfolio company along with a GP or a private equity sponsor in their fund. So private equity manager would go out, buy a portfolio company. The equity needed might be a little bit too large for the fund or several other reasons. They would go out and ask limited partners like us, like, hey, do you want to co-invest alongside us into this particular deal? And the kick is usually they are offered to LPs at no fee, no carry. So that makes it very interesting for us. We gain exposure to a manager that we like, increased exposure to a manager that we like, to a deal that we like at no fees, no management fees, and no carry. If we can do that at scale, we would be averaging down our management fees over time, which should benefit our overall performance and of course make us look a little bit better. So that was the main reasons. Other reason why we want to do that is we get up close, in detail look at how our managers actually structure these deals, how they're underwriting an individual company. Usually when we commit to a fund, it's a blind pool. We don't know yet what they're going to buy. We have an idea, but we don't know the individual deals. On a co-investment, you're literally in the weeds, looking under the hood. How do they do that? How do they model the deals? So that would help us and become better investors ultimately and help us do a better due diligence job on our managers. The difficulties or the crux is co-investments are very opportunistic, sporadic, and operate under an accelerated timeline. So I might go back to my desk after I leave here and have an email in my inbox. Hey, there's some co-investment opportunity for fund XYZ. We need indication of interest and NDA signed by Friday. And we have 4 weeks to close on any kind of legal things and reviews. So that might work if I can tell John, it's like, hey, I'm out for the next month. I'm going to focus on this co-investment deal. Ian can tackle the rest of my work. Unlikely for that to happen. So with that in mind, we set out as like, hey, we need help. We can't do this internally. We don't have the bandwidth. We don't have the staffing to review these deals and allocate at scale efficiently, economically. We set out, we need help. What do? We underwrite managers. So we looked out to find a manager that can help us do this, exactly that. Mapped out the market, talked to about 16. If Ian was here, he would tell you exactly how many. Found our top 3, flew them out to Helena, had some deeper due diligence discussions with them, and ultimately we selected Fisher Lynch Capital, as you see here on the board brief. Fisher Lynch Capital, 20-year track record of doing exactly that. Direct company co-investments with a broad range of GPs in the buyout space for their respective LPs. And that's exactly what they're going to do for us. They will manage a fund of one or an evergreen SMA type structure that will co-invest on our behalf with our dollars for the pension in our GPs that are in the portfolio. Since we kicked that off in July, we've already seen 5 or 6 deals. 2 of them are still live. Very likely that we might close one of those here before quarter end. Can't promise it, but it's looking pretty good. And I mean, everything else is on the page, the usual things that we like, long history, employee owned, and then I'll just highlight the one thing, very attractive fees that we were able to negotiate here. I'll pause there, just on Fisher Lynch, and see if there are any questions, comments, discussions. So I see anything. I hit on 10X on builders already. I'm happy to go through the board briefs if there are any particular questions on those two managers, but as I said, existing relationships, re-ups, very happy with them so far. Seeing
No questions, I guess, so.
Good.
Thank you, good
Appreciate
job.
that. Thank you very much for your time. I'll pass it on to John in Moscow.
Haven't we seen you before?
Did you miss me?
Yes, we met.
All right, thanks. If I could refer the board to slide 48, looking at core fixed income, point out that we had returns close to the benchmark, a little bit better. State fund had significant outperformance to the benchmark as their duration was better. It was lower than the other funds, and so they were not so impacted by the increase in interest rates that resulted in some decline in the return of the portfolio. So you might recall that a little over a year ago, we changed the benchmark for state fund. And so we were significantly short the new benchmark, and over time have increased the duration of that portfolio to close to neutral right now. Looking at the slide on the next page, on page 48, 49. You know, this is really interesting to me. First of all, you can see the twist around the 3-year. The green line is what the yield curve was on June 30th, 2024, and I guess I'm gonna call that an amber line is what it was a year before. So you can see the twist right around the 3-year. And the front part of that, the short part of that curve, that's easy to understand. You know, expectations of Fed moves are going to drive that short-term interest rates down. What's a little more interesting is the increase from there on out in yields. And so in normal times, we would expect that that's an expression of expected inflation. But what we see in TIPS portfolio, in TIPS securities, Treasury inflation protected securities, does not align with that. That expectation throughout the year was something in the neighborhood, mid to low 2% inflation range there. So it's an interesting thing, you know, at the end of the day, it's an expression of supply and demand. So you could argue that the supply is too high and the demand is too low, and that's what drove interest rates. But for me, the interesting part is the effect that we saw on our portfolios. Like I said, we performed close to the index for the pension and the trust funds. But in a rising interest rate environment, we would have expected those to significantly underperform because we were long duration. And so looking for reasons why they didn't underperform, it has to do with selection, or when we look at the attributes to that performance, it shakes out in selection, which sounds like, cool, John selected the right securities, but it is a technical term that is essentially saying that it is return not otherwise ascribed to some factor of a model. Think duration, think twists in the curve, think changes in credit spreads. So we had positive selection across every asset class except for treasuries, which, you know, we use to definitely drive the long duration. And so some of that could be due to the timing of when we had cash flows in and out. The timing itself is not the issue, it's when I raise cash or put cash to work, that can have an effect. And we could see that there were a couple of peaks in interest rates and a couple of valleys in interest rate throughout the year. And so when we extended duration, we tended to do it at the peak of the interest rates and less so in the valley. So that certainly helped. But it can't explain it all. Again, the selection is just the statistical anomaly that can't be explained by something else. And it could be manager selection, but it may just be something that can't be attributed. And so when John Putnam says that we fell ass backwards into outperformance, I might super glue his coffee cup to the desk, but I can't statistically prove him wrong.
Well, I give you approval to do that.
All right. In his case, I should say teacup. Going on to how the portfolios are positioned now, page 5 for the core internal fund, you can see that our duration is about 114% of the index, so the expectation is for declining interest rates going forward. We do have a small yield advantage, and our contribution to duration, our credit risk is below the index. It's as low as I would like it to go, and we will probably at least maintain there and look for opportunities to increase credit risk, but being judicious given currently low spreads. More of the same theme for the trust funds, again, long duration, credit, or I should say yield advantage, and a little bit light on credit. Looking at state fund on slide 52, there you can see that, well, we were just slightly long the index in terms of duration. Still looking for opportunities to extend that duration, but there are cash flow needs of the client that will limit us somewhat there. Still got a yield advantage, and we'll continue to look there again for adding credit risk.
On that, it says not classified, what is in that, on the credit rating chart?
Yeah, so not classified is generally, well, it's all US agency securities where the individual security is not rated, but the parent is rated.
Okay.
Same as the government. So you could call that AAA.
Okay, good
stuff. Any other questions? Thank you for taking it easy on me, Jack.
It's the new me.
All right.
Okay, I think we're done with the investment update. Is there any questions from anybody? If not, Dan, we get to see if we can get some work to you. Does anybody have anything that Dan needs to be doing?
He's got lots of stuff that's, you gotta be doing, you're gonna be coming our way.
Yes.
You'll be having plenty. Have all those reports. I'll report back to you on the budget fund type. We've got down payment 3.0. And I believe our next meeting is October 9th. So
that'll be even with all that stuff a one day.
I can't promise that right now. We may need, well, let me put it this way. Let's keep October a one-dayer. And if we need to spill over into November where we've already got 2 days booked, we'll do that.
Okay, good.
So yes, October will be a one-dayer. If we need more time in November, we'll take it. and then we'll break till February for the holidays and the rest of it. Likely, I will be sending you much of this information over the course of the next several weeks. We may be able to expedite some of the conversations if you just call me in the interim. But, you know, we will be available, and then, as I mentioned before, if we have investment policy statement revisions, or not only investment policy statement, but if we have policy revisions that need the board's approval, we will bring those to you as soon as they're ready, rather than delay them till the subsequent meeting. So we'd move on the action item sooner, and any sort of just general reports of procedures the staff did to address those analyses, we'll wait for the November meeting.
And we settled on dates for 2025 for the board meeting.
They will be, we have the drafts out, they were in the last meeting packet. We've not voted to approve those, we were waiting on PERS and TERS to figure out their dates, but they'll be for full adoption at the next meeting.
So is there any loans on the horizon or anything else that we could be looking for?
Nothing, there's no big ones that we've seen. That $15 million threshold within DNRC has been hugely helpful to just expedite processes. I don't see any, I don't think we've got any in the commercial system that would rise to full board.
Okay.
But we'll bring it in October. You will have staff evals coming up, so you'll have your staff that John and I prepare, and then all of the staff that I prepare that I give to you as an FYI.
That's in October as well?
I believe that is October, yes. Yes, the exempt staff review and the SOC audit. And you get to see John Ramasco again for the separate accounts deep dive. We'll just get him a chair.
Yeah, I'm not sure he'd like that. Anything else, John, from you that?
Anything else for me?
Okay, I appreciate when you write a memo once in a while, just so we don't panic or anything.
I try to gauge that, but be judicious about how often I send such things.
John, you wrote that memo and things just.
It turned right around, didn't it? That's what happens.
So with that, unless there's anything else from any board member, if not, I really appreciate all the work you guys do here. Thank you, Dan, and thanks to all the staff. Meeting adjourned.